Welcome to the Opening Bell Report.
I was looking at the tape yesterday morning, and you really just don't see a move that violent on a quarterly print very often.
No, you really don't.
I mean, Iovance Biotherapeutics, ticker IOVA, for those of you tracking this at home, it didn't just gap up, it completely decoupled from its recent trading range.
Right.
We're talking about a 30% surge in a single session.
Yeah.
And, looking at the volume profile in the analysis report we're diving into today, this wasn't just retail traders chasing a headline. This looked like heavy, aggressive institutional accumulation.
Oh, it absolutely was. And frankly, if you've been tracking the technicals on IOVA, this is what you'd call a textbook breakaway gap.
Yeah.
The stock had been basically coiled in that mid-$2 range for months, effectively pinned down by short interest and, well, just general biotech fatigue in the market.
Right. Biotech has been a tough neighborhood lately.
Exactly. But when you get a catalyst that is this multifaceted, financials, operations, and pipeline all hitting at the exact same time, that stored energy has nowhere to go but up.
It's explosive.
It really is. It leaves the bears trapped in a pretty nasty position,
Right.
Which, for the bulls, is exactly what you want to see.
Yeah, the short squeeze dynamic was definitely in play here. And we'll get to those market mechanics a bit later in this deep dive because the pain trade there is just fascinating to break down.
It's a classic setup.
But I want to start with the fundamental trigger because we've seen biotech stocks pop on hype before.
Oh, all the time.
And then they just fade the next day, right?
Yeah.
But this feels different to me. It's backed by a massive earnings beat. According to the analysis report, they posted Q4 revenue of $87.1 million.
Right.
And the consensus was sitting at roughly $82 million.
That's the headline number, yes. But if you really dig into the breakdown here, the raw revenue figure isn't even the most impressive part of the story. No, it's the velocity of the growth. That $87.1 million represents a staggering 30% quarter-over-quarter increase from Q3.
30% in one quarter.
Exactly. And to give you some context, in the commercial biotech space, specifically when you're looking at oncology launch phases, you normally see a plateau.
Right, the initial rush.
Yeah, the initial bolus of patients, the ones who are sitting there desperately waiting for the FDA approval to get treated. Once they get treated, the numbers tend to flatten out.
So the pent-up demand wears off,
Yeah.
and then you're just left looking at the real, organic, everyday demand.
Precisely. But Iovance isn't plateauing at all. They are accelerating. That 30% sequential growth tells me that the adoption curve is actually steepening.
Wow.
This isn't just them working through a backlog anymore. This is new demand generation across their whole authorized treatment center network.
And looking at the product breakdown in the report, it seems the bulk of this money is coming from Amtagvi, right? Their flagship melanoma therapy.
Heavily driven by Amtagvi, yes.
They pulled in $220 million for the full year, 2025, just from Amtagvi alone, with Proleukin adding another $44 million. So total product revenue hit $264 million.
Which is a huge milestone.
It really is. And it lands squarely in their ambitious guidance range. Management actually did what they said they were going to do. And let's be honest, in the biotech sector, doing what you say you're going to do is becoming a bit of a rarity.
Credibility is a currency all its own in the space. Hitting that $264 million target completely validates their commercial model to Wall Street.
It proves they can actually sell the drug.
Right. But I want to circle back to your point about organic growth. You, as an investor or observer, have to consider where this revenue is actually coming from. It's not just one or two major academic research centers anymore.
They're branching out.
They are scaling the onboarding of regular hospitals. The fact that they beat consensus by over $5 million in Q4 suggests that the utilization depth, meaning the number of patients being treated per hospital, is increasing.
Doctors getting comfortable with it.
Exactly. They aren't just trying it once on a single patient. They are making it a standard workflow.
That brings up the profitability question, though, because I'm looking at the bottom line here in the analysis report, and they reported an earnings per share, an EPS, of negative 18 cents.
Right.
And the street was forecasting negative 17 cents. So technically speaking, they missed by a penny.
They did.
In a different market environment. Or maybe if we were talking about a big tech stock, an EPS miss usually triggers an immediate sell-off. But here, the stock rips 30%.
Yeah.
So why did the market completely ignore the EPS miss?
Because in this very specific phase of Iovance's life cycle, what we call the commercial biotech phase EPS is basically a lagging indicator of success.
Okay, explain that.
Well, revenue growth and adoption rates are your leading indicators. Investors know that Iovance is still actively building out their physical and commercial infrastructure.
Which costs a lot of money up front.
Exactly. So losing a penny more per share right now is completely irrelevant if it means you just captured 30% more market share sequentially.
They're buying land, essentially.
Yes, the market is pricing in the future leverage, not the current spend. Investors are looking for sales velocity. If revenue had been flat, and they also missed EPS,
the stock would have cratered.
it would have been a bloodbath. But top-line growth cures all sins in this phase of a company's life.
Well, speaking of leverage and future profitability, transitioning from how much they sold to how efficiently they sold it, the unit economics update in this report was arguably the most bullish part for me.
Oh, easily.
Because we've watched cell therapy companies, like the CAR-T players, for instance, we've watched them struggle for years. They are usually total cash incinerators because the manufacturing is so bespoke. It's wildly expensive to make these autologous therapies.
It's historically been the Achilles heel of the entire cell therapy space.
But Iovance reported gross margins jumping to 50% in Q4.
That is a massive inflection point. You have to remember, they were sitting at around 43% in the prior quarter.
Right.
A 700 basis point expansion in a single quarter is almost unheard of in manufacturing-heavy biotech.
So how exactly did they pull that off? Is it just a volume game?
Volume is certainly part of it. When you spread your fixed facility costs over more doses, your margins naturally improve. But it's also about process optimization.
Better science.
Better science and better logistics. They are getting better at the actual physical manufacturing process. They've reduced failure rates. They've streamlined their supply chain. And notice the guidance they gave.
The 70% target.
Right. Management is now openly aiming for 70% plus gross margins in the coming years.
Which is wild, because 70% takes them out of that low-margin service provider profile and puts them into true high-margin biopharma territory. That fundamentally changes the terminal value of the company.
Precisely. Think about the math. If they can sell a therapy for $500,000 and keep $350,000 of it, the cash flow generation at peak sales is enormous.
It's a money printer at that point.
It is. But there's a metric hidden in here that drives that margin expansion, and honestly, it's even more critical for the patients themselves.
The turnaround time.
Yes, the manufacturing turnaround time.
The vein-to-vein time, as they call it.
Right. In the report, they confirmed they have reduced the turnaround time for Amtagvi to 32 days or less.
I want to pause on that because I think the financial and human implications of that number really get overlooked by casual observers. Obviously, for a stage 4 melanoma patient, speed is literal life or death.
It is the only thing that matters.
Right. If you wait too long, the patient deteriorates, their organs fail, and they physically cannot take the drug when it finally arrives. But from a purely revenue perspective, reducing that time to 32 days also drastically reduces the dropout rate, doesn't it?
That is the exact key connection you have to make. In early clinical trials for these types of therapies, you would see a significant number of patients enrolled who never actually received their infusion.
Because the manufacturing took 60 or 70 days.
Exactly. And by the time the cells were ready, their disease had progressed too far. By cutting this wait time down to 32 days or less, Iovance is essentially closing that leaky bucket.
So a higher percentage of orders actually turn into realized revenue.
Yes. It's a logistical victory that directly feeds the top line. Speed equals viability for the patient, and it equals revenue for the company.
And it creates a massive competitive moat. Think about it. If a competitor somehow comes along tomorrow with a similar TIL therapy, but it takes them 50 days to manufacture it, Iovance is going to win every single time.
Every time. Oncologists won't risk the wait. Reliability and speed become your ultimate competitive advantage. And all of this operational efficiency ties directly back to their balance sheet.
The cash runway.
Right. Because they are converting orders to cash faster and doing it with 50% gross margins, their overall burn rate is stabilizing.
The report says they ended the year with $303 million in cash. And in the biotech world, cash runways are basically the constant existential threat looming over every stock.
Always.
But management is saying this specific runway now stretches deep into Q3 2027.
And that 2027 date is highly significant for institutional investors.
Because it removes the veil of dilution.
Exactly. It signals to the market that there is no imminent secondary offering coming. Usually, when a clinical stage or early commercial biotech stock pops 30% in a day, the company immediately announces they're selling more stock to raise cash.
Which instantly kills the momentum, the dreaded selling into strength. Investors hate it.
They despise it. But with a runway extending to late 2027, Iovance has broadcasted that they don't need to do that. They don't need retail's money right now.
It removes a massive overhang from the stock. You can buy shares today without waking up tomorrow to find out your position got diluted by 20%.
Right. It allows the stock to finally trade on its actual fundamentals rather than pure financing risk.
Okay, but a runway to 2027 is great, but that cash still has to fund something. And this is where the narrative of this deep dive really pivots from just commercial execution to absolute blue sky potential.
Rocket fuel.
Yeah. Because if Iovance was just a melanoma company, their valuation would be naturally capped by the size of the melanoma market. But the pipeline data they dropped alongside its earnings report, that was the real secret catalyst here.
It caught the street completely off guard. We all knew they were looking at other indications, but the pilot data they released for advanced soft tissue sarcomas.
Specifically UPS and DDLPS.
Yes, that data was nothing short of shocking.
Let's clearly define the stakes here for you listening, because these acronyms hide how brutal this is. UPS, which is undifferentiated pleomorphic sarcoma, and DDLPS, dedifferentiated liposarcoma, these are incredibly nasty, aggressive cancers.
Horrific diseases.
My understanding from the analysis report is that once a patient fails their first-line chemotherapy, there is almost nothing left in the arsenal.
It is essentially a therapeutic desert. The current standard of care for these heavily pretreated sarcoma patients offers an objective response rate, an ORR, of less than 5%.
Less than 5%?
Yes.
So effectively, the current treatments on the market just do not work.
They are palliative at best. They might buy a tiny bit of time, but they aren't turning the tide. Now, you have to compare that dismal baseline to the pilot data Iovance just released.
Okay.
Using their TLL therapy, lifileucel, in these exact same pretreated sarcoma patients, they achieved a confirmed ORR of 50%.
I want to make sure everyone hears that clearly. 5% standard of care versus 50% with Iovance. We aren't talking about a minor statistical win where it's, 7% versus 5%.
No.
That is a literal tenfold improvement.
It's an order of magnitude shift in efficacy. And to really grasp why the market went crazy for this, we have to consider the biological context.
The hot versus cold tumor debate.
Exactly. Sarcomas are historically considered cold tumors. That means the patient's immune system has a very hard time recognizing the cancer cells as a threat.
They cloak themselves.
Right. So blockbuster checkpoint inhibitors, drugs like Keytruda, they often struggle to gain any traction in sarcomas.
Which is exactly why Wall Street has been so skeptical about expanding TIL's tumor-infiltrating lymphocytes beyond melanoma, because melanoma is a hot tumor.
Right. Melanoma has lots of mutations. It's very noisy, biologically speaking. It's easy for the immune system to spot.
So the bare thesis for Iovance has always been, sure, your TILs work great in melanoma, but they will never work in cold tumors like sarcoma. You're a one-trick pony.
And this new data completely shatters that bare thesis. Getting a 50% response rate in a notoriously cold tumor type proves that the underlying platform is transferable.
That's not a fluke.
No, it validates the entire technology across a much broader spectrum of oncology. That is exactly why the stock repriced so violently. The total addressable market, the TAM, just got significantly larger in a single afternoon.
And they aren't wasting any time capitalizing on this. The report notes they're launching a registrational trial for sarcoma in Q2 of 2026. And the phrase accelerated FDA approval path was explicitly used.
Which is huge.
Given that data, the 50% versus 5%, I have to imagine the FDA is going to be very motivated to get this through the pipeline.
The FDA has a clear mandate to address severe unmet medical needs. When you have a terminal disease with a 5% response rate and a new therapy walks in the door offering 50%, the risk-benefit analysis skews heavily and rapidly in favor of approval.
They want to say yes.
They do. Iovance is perfectly positioning this for a rapid expansion of their commercial label.
So if we look at the big picture, we have the melanoma cash cow currently funding the massive sarcoma growth engine. It's a textbook biopharma maturity model playing out in real time.
It's execution at its finest.
But I want to briefly shift gears back to the price action.
Yeah.
Because we mentioned the trapped bears at the top of the deep dive. And for the financially curious folks listening, the market mechanics here are a story all on their own.
The short squeeze.
Yeah. I pulled this short interest data from the analysis report. Prior to this earnings release, the stock was heavily consolidated in the mid-$2 range, and a staggering 18% of the float was sold short.
Which is exceptionally high. That's a very crowded short trade.
Very crowded.
Yeah.
And looking at the days to cover metric, it was sitting around 6 or 7 days, meaning based on the average daily trading volume, it would take those short sellers a full week of continuous buying just to exit their losing positions.
Right.
But when the stock gaps up 30% right at the opening bell, pushing into that 380 to 390 range, they don't have a week.
No, they have minutes.
Exactly.
That creates an immediate liquidity crisis for the shorts. They are suddenly staring at massive, technically unlimited losses in their portfolios. So they panic.
They hit the market buy button at any price available.
Yes. And this is the core mechanism of a short squeeze. You have the fundamental investors buying the stock because of the amazing revenue beat and the new sarcoma data. And layered right on top of that, you have short sellers forced to buy just to survive the morning.
It's artificial buying pressure stacked on top of organic buying pressure. It has absolutely nothing to do with valuation models at that specific second. It's pure risk management.
Exactly. And that dual pressure completely explains the violence of the upward move. But what I find really interesting here is that Unlike a meme stock squeeze where the price just collapses back down an hour later once the shorts are finally out.
Iovance held its gains.
It did. It closed near the absolute highs of the session.
And that's the key differentiator, right? That tells me the real money, the large mutual funds, the institutional healthcare funds, they were stepping in to aggressively absorb that volume.
Absolutely.
They're looking at that 2027 cash runway and the 50% margins, and they're saying, okay, this is finally investable for us.
It marks the transition from a speculative, cash-burning clinical biotech to a real commercial growth stock. Big institutions generally can't touch a company that might go bankrupt in 6 months.
It's outside their risk mandate.
Right. But a company with over $300 million in the bank, growing revenue 30% sequentially, and gross margins rapidly hitting 50%, that fits their mandate perfectly. What you're seeing on the tape is a fundamental rotation of the shareholder base, from retail day traders to serious long-term holders.
All right, let's play the skeptic for a minute, though. It can't be all green lights and blue skies. Even with $303 million in the bank, running a full phase 3 registrational trial in sarcoma is going to be incredibly expensive.
Very expensive.
And they're still actively expanding the melanoma commercial launch, which requires hiring more sales reps, marketing budgets, complex logistics. Is there a genuine risk that the cash burn rate starts creeping back up and eats into that nice 2027 runway?
That is undeniably the primary risk here. Clinical trials are notoriously expensive, and pursuing an accelerated approval doesn't mean it's a cheap approval.
Right.
If management decides to go full throttle on multiple new indications all at once, say lung cancer, endometrial cancer, and sarcoma simultaneously, that impressive cash pile will dwindle a lot faster than currently projected.
So the execution risk has fundamentally shifted. It's no longer can they make the drug, it's can they manage the portfolio without going broke.
Correct. Management has to remain highly disciplined. They can't just chase every shiny scientific object. They need to let the growing Amtagvi revenue organically fund the pipeline development.
Because if the top line growth stumbles.
Right. If next quarter we only see 5% revenue growth instead of 30%, that entire 2027 runway calculation completely falls apart. The market is betting heavily on continued flawless commercial execution. They have to keep feeding the beast.
And there's also the competitive landscape to keep in mind. Are there other cell therapies actively targeting these sarcomas? Or is Iovance basically running this race alone right now?
In the specific TIL space, they are the clear, undisputed leader. Now, there are other TCR therapies and CAR-T therapies looking at solid tumors in early trials.
But solid tumors have been tough for CAR-Ts.
They are the holy grail that CAR-T hasn't really been able to crack yet. The microenvironment of these solid tumors is incredibly hostile to engineered cells, but TILs, because they are polyclonal, meaning they naturally attack multiple different targets on the cancer cell simultaneously, they have a massive theoretical advantage in these complex environments.
And this new sarcoma data is the first hard proof that this theoretical advantage is actually real in a commercial setting.
Exactly. It takes it from a whiteboard theory to clinical reality.
So if you're looking at Iovance today, based on this entire analysis report, you're essentially buying two distinct things. You're buying the existing de-risked melanoma business, which is rapidly becoming highly profitable, and you're getting a free call option on the entire sarcoma pipeline, and really whatever comes after it.
That is a very fair and accurate valuation framework. And honestly, I think the whatever comes after it part is what keeps oncologists and investors up at night in a very good way.
Because the implications are staggering.
They are. Because if these TILs work this well in sarcoma, a notoriously cold tumor, do they work in cervical cancer? Do they work in non-small cell lung cancer?
And we have seen glimmers of early data in lung cancer before from them.
We have. And if Iovance can somehow replicate this newly found operational efficiency and combine it with a 50% response rate in a massive indication like lung cancer,
then we aren't talking about a $3 or $4 stock anymore.
Not at all. We are talking about a major top-tier pharmaceutical acquisition target or a standalone large-cap biotech powerhouse.
Which is really the end game here. Big pharma is desperate for assets that actually move the needle in solid tumors. They have the massive global sales forces. They just need the actual product to sell. And Iovance is effectively de-risking the product for them quarter by quarter.
And remember the manufacturing turnaround time being cut to 32 days? By doing that, they've systematically removed the biggest single objection Big Pharma has always had with cell therapies, which was it's just too hard and too slow to make.
Iovance has definitively proven that it's scalable.
Exactly.
It really is just a complete monster quarter. You check the box on accelerating sales, you check the box on expanding margins, you check the box on the cash runway, and then you just drop an absolute bomb on clinical efficacy in a new indication. It is extremely rare to see all those stars align in biotech.
It is rare. Usually you get great clinical data, but the company is completely broke and has to dilute. or the company is rich with cash, but their lead drug just failed a phase 3 trial. To have the commercial engine humming so smoothly while the R&D engine simultaneously delivers a true scientific breakthrough, that is exactly why the stock exploded 30%. It's a top-to-bottom validation of their entire business model.
So for you listening and tracking this story, what is the next major milestone to look out for? Obviously, we have the Q1 earnings coming up in a few months, but is there anything specific in the data to watch?
I would closely watch the ATC, the Authorized Treatment Center onboarding numbers. We want to see that hospital network continue to grow aggressively. And of course, watch for any more granular data updates on that sarcoma cohort.
More patients in the trial.
Exactly. The more patients they can add to that 50% response group, the more statistically real and undeniable it becomes to the FDA and the market.
And of course, keep a very close eye on that cash burn. As long as the revenue continues to grow faster than the expenses, the core thesis here remains completely intact.
Leverage is the absolute name of the game right now.
Well, it's incredible stuff. It's not every day we get to break down a market move this violent and significant that is actually fully justified by the underlying fundamentals. So thank you for walking us through the complex market mechanics and the heavy science today.
Oh, my pleasure. It is a truly fascinating case study in commercial biotech execution.
It really is. And as we wrap up this deep dive, I want to leave you with a final thought to mull over. We've talked about the leap from a 5% to a 50% response rate in sarcomas using this TIL technology. If Iovance is proving they can successfully turn a cold, untreatable tumor into a highly manageable one, what other untreatable solid tumors are sitting out there right now just waiting to be unlocked next? Are we currently watching the beginning of a massive, broader shift in the entire standard of oncology? It's something to think about. Keep watching the data, don't just read the headlines, and we'll catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.